Hey guys, this is Fred Passelli. Welcome back to the channel. I'm a CPA based out of South Florida, practicing in tax planning, tax strategy, and bookkeeping services for small businesses and individuals. So today's video that I want to talk to you about is how to know the difference if you should be doing a pre-tax or post-tax retirement account. So first I'm going to explain what the differences are between them, and then how to help determine which one you should be doing based off your current tax situation and overall financial planning. So pre-tax accounts are basically retirement accounts that are going to be tax deductions currently. That's why they're called pre-tax accounts. And examples of those are going to be 401ks, 403bs, 457s, traditional IRAs. So 401k, 403b, 457s, those are all names of the account types. 401ks you're going to see most commonly at your private companies or publicly traded large entities. 403bs and 457s are mostly going to be at governmental agencies or some maybe public education, universities, colleges, or school district types. Then the traditional IRA, anyone can open that up. Basically, you can open that up with an account like Charles Schwab, Fidelity, Vanguard. So those are all examples of pre-tax retirement accounts. What that means is in the current year you're contributing to those accounts, that is when you're going to get the tax deduction. So in some cases, it might make sense for you to take advantage of that. It might not make sense. First, let's then explain what the post-tax retirement accounts are. So really the main post-tax retirement accounts that I'm going to focus on today are going to be Roth IRAs and then Roth 401ks or Roth 403bs or Roth 457s. So basically it's going to be some form of the first account, but in a Roth format. Roth is essentially meaning you pay taxes now, but then it grows tax-free forever. So essentially all the gains, dividends, reinvestment, and even when you draw on it after 59.5, it will all grow tax-free. So the first account is tax deductions, and the second account, post-tax, another name could be called tax sheltered. So the main way to differentiate in what might be most advantageous for you right now is depending on what your current marginal tax bracket is. That's why in other videos in the past, or even in my blog, if you subscribe to it, you'll see it's very, very important to figure out what your current marginal tax bracket is, because that is going to help you plan and tax strategize on what type of tax retirement or post-retirement or pre-tax retirement account you should be contributing to. So I'll give you an example. If you are essentially right now in the 22%, 24%, let's say your 30% tax bracket, marginal tax bracket. So every dollar or additional dollar you make will be taxed at 30%. So that's a pretty high tax bracket right now. Let's say though, when you retire one day, you are only going to be taxed at essentially 12%. So does it make sense to take the 30% deduction right now? Because every dollar you contribute to the pre-tax will be saving you 30% on your marginal bracket versus the 12% in your retirement. So the spread there is about 18% in tax savings. So what it depends is, are you going to earn a lot more right now than what you're going to earn in retirement, or vice versa? That's what you need to figure out. So if you're planning to have $1 million or $2 million in retirement and you're going to draw down on that over 30 years, 20 years, whatever your projections might be, and that comes to maybe $70,000 a year income, and you're only going to be taxed 12% on that, then maybe it makes sense to take the pre-tax deductions now when you're getting taxed 30%, and vice versa. If you're never going to earn maybe above 60, 70, 80,000, and one day your retirement egg is going to be basically going to pay you about the same amount. Let's say it's similar to $1 million, and you're going to draw down on it, getting $60,000, $70,000 a year, then it might make more sense to use the Roth IRA account. It's a case-by-case basis, and it is a gray area. It depends what's your marginal bracket. What is your current overall retirement plan strategy? Do you want to wait until you're 59 and a half to access these funds? You have to factor in what a dollar is worth today versus what a dollar will be worth in 30 years. Do you want to take the risk of possibly paying the 10% penalty? So one benefit of a Roth IRA is that you are able to withdraw all contributions penalty free. So if you're doing the max, which is $7,000 a year, and you do that for 20 years, that would be $140,000. So essentially you can start drawing on that $140,000 penalty free. So there's different pros and cons, whether you want to do pre-tax or post-tax. Just to reiterate, examples of pre-tax retirement accounts would be a 401k, 403b, 457, traditional IRA. Then you have some for small businesses, which I didn't touch on, but I'll just say briefly, a SEP IRA or a solo 401k. Then you have the post-tax retirement accounts. Those will be Roth IRAs, and then the same 401k Roth, 457 Roth, 403b Roth. So, like I said, the main thing to look at is figure out your marginal tax bracket, set up a plan on how much you want to have in retirement, whether that's $1 million, $2 million, $3 million. Figure out how much you would get income per year if you were to draw down on that. Figure out how much you're going to draw down per year, what that will be taxed at, and then create a plan. Are you in a higher marginal bracket now, or will you be in a higher marginal tax bracket when you retire? So that's the best you can do right now to figure out, should you be doing pre-tax or should you be doing post-tax. Now, I do know some individuals just choose to do pre-tax because they can set it up, automate it at their company, let their company handle it, and forget about it. And it can just grow year over year over year, tax deferred. Could be of some benefit. Personally, I used to like to do that because I just forget about it, and I like to see my account grow. Every 2 weeks, I get a deduction, and it goes straight to that account, and basically the brokerage handles it. Now, the other thing that you have to keep in mind, which none of us know about, is going to be changing tax rates in the future. Now, as of right now, we don't know what tax rates are going to be in the future. People can say they're going to go higher. People could say they're going to go lower. You know, most people like to assume that they're only going to go higher in the future due to, the national debt. But you really never know, because in 2017, we had a major tax rate cut, and it's pretty much the same now. And that's going to be a 10-year period now, from 2017 to at least 2029, so closer to 12 years, where we have lower tax rates than we did, 2008 to 2017. So it's really hard to forecast what tax rates are going to be. So the best thing you can do is make your decisions based off what it is right now. So understand your retirement situation, make a plan, learn your marginal tax bracket rate that you're currently at and what you might be at when you retire, and then that will help you drive your decision making. Learn the different types of accounts you might have access to at your company, or if you want to open up one at a brokerage like Charles Schwab or Fidelity, those are good examples, or even Vanguard. Like I said, so that's the basics of the pre-tax, post-tax discussion. If you really want to go more into it, there's lots of materials about how to invest. I'm not going to go into that in this video, but I suggest you understand basics of index funds and portfolio asset allocation just to get familiar with it if you're going to invest on your own. If not, it might make sense to look into a money manager, but it really depends. It's up to you. It's up to your risk tolerance. All right, guys, I hope you enjoyed the video. If you guys liked it, please subscribe, and I will see you guys again next week. Thank you.